Mr. K.K. Mistry, Vice Chairman and Chief Executive Officer of HDFC Limited. Mr. Mistry, good morning. Thank you for joining us. Mr. Mistry, the budget had some positive measures on the housing industry. What is your outlook on growth for the housing industry and then the housing sector?
See, the growth in housing right through this current year, the demand for housing loans has been very strong. You've seen the results for the first 9 months of this year. And in the individual housing loan category, when we add back loans sold in the last 12 months, we had a growth of as much as 31%. So it's been a very strong growth in the first 9 months of this year. Now, in the finance bill that was released a couple of weeks, 3 weeks ago, there is a new provision which says that for a middle-income customer, which is typically a person who's buying a home for the first time, provided his loan amount is less than 25 lakhs and the property value is less than 40 lakhs, and he takes the loan anytime after 1st April 2013 and before 31st March 2014, there will be an added tax deduction of 1 lakh rupees towards interest. So this is in addition to the existing benefit of 1,50,000 which is there. Now this 1 lakh benefit can be availed over a 2-year time frame, either in 2013-14 or in 14-15. So we clearly believe that something like this will act as an incentive, and more people will want to buy a house during this period and therefore will be wanting to take housing loans. So it's early days to say what kind of growth numbers we will see, but we definitely see this providing a big fillip, not just to the housing sector, not just in terms of demand for housing loans, but also more so in terms of providing support to the core economy, because as you know, housing supports a number of other industries. There are something like 276 industries in India, big and small, which depend on the housing sector. The big ones being cement, steel, paint, small ones being nuts and bolts. So effectively by encouraging the housing sector, you're providing support to all these other industries. So I think it will be good for the industry.
KK, urban income has been slowing while demand remains strong in Tier 2 and 3 cities. What is the growth rate that you see in the Tier 1 and 2 cities as well as 3?
So if you look at it in terms of locations, the largest business would, number one business is from the Delhi NCR region, second is from Chennai, third is from Mumbai, fourth will be Bangalore, followed by Pune. But now it's not business, and it is not business originated just in these cities. It includes the outskirts of the city. So for example, if you look at Pune would include places like Satara, Sangli, Kolhapur, Sholapur, Aurangabad, and so on and so forth. So growth is happening everywhere, not just in the Tier 1 cities, but in the Tier 2 and the Tier 3 cities as well.
Kiki, give us some sense on the color of the loan growth that you are seeing in the retail wholesale book for HDFC.
See, we've seen the December results. The individual loan book is as much as 31%. Non-individual book increase was 16%, giving an overall increase of around 25%.
So overall, what is the kind of loan book growth that you see over FY14 and 15?
It's difficult to make a projection for what is going to happen over the next 1 year, but I would expect that the growth would continue to remain strong, especially given the fact that now there are these additional tax benefits provided to individuals for buying houses.
Give us some color on how are the spreads shaping up for your retail business and for your wholesale business. Overall, do you see spreads remaining stable?
Spreads have been stable. Currently, as of December, we were operating with which were 2.28%. If you break out that 2.28 between individuals and non-individuals, individual spreads were at 1.95%, non-individual spreads were at 2.79%. And even incrementally, if you were to look at the month of January and February, spreads have remained in the same range. So incremental loans given in Jan and Feb have been at more or less the same spread.
KK, the borrowing profile has been more skewed towards deposits and bonds, and share of bank loans has relatively come down as well.
See, we have to keep and we always have kept a very flexible approach to funding. And we would like to raise money from that source, which gives us access to the cheapest form of funding at that point of time. So in periods of time when interest rates are high, Usually it is retail funding, which is retail deposits, which is the cheapest form of funding for us. In periods of time when interest rates are low, wholesale funding tends to be a lot cheaper than retail funding. So we continue to keep a flexible approach to funding, and depending on where interest rates are in the system, we would look at raising funds from that source at that point in time.
Right. Mr. Mistry, share of profits from subsidiaries and associates has been increasing. What is your outlook on subsidiaries and associates going forward?
Sure. If you look at our share of profits in the first 9 months of this year, the subsidiaries put together have accounted for 28% of the consolidated profits. So subsidiaries this year have accounted for 28% of consolidated profits compared to 24% in the previous year. And we've always been saying that over a period of time, the share of profits of the subsidiaries as a proportion of the consolidated profits will keep increasing, because some of these come from a lower base and therefore the percentage growth will be higher. So I would hope that when we get into the next financial year, the share of profits of the subsidiaries as a proportion of the consolidated profits will be higher than the current level of 28%.
Right. So post the monetary policy, what is it that you're expecting, KK, from the RBI in terms of a further repo or CRR cut over the rest of 2013?
A rate cut of 75 to 100 basis points during the course of the year, this calendar year. And I had said earlier that we should be probably getting the first rate cut in January, which we did, that we would get probably the second rate cut in March or April, which again we got that 25 basis points cut. And I think now RBI will watch for a while, see what kind of monsoons we get, see the rains, how inflation numbers, the growth numbers and all pan out, and then take a call sometime in July, August. So for at least for the next 2 months or 3 months, you may not see a rate cut coming through in the system. See, the present problem of liquidity or shortage of liquidity in the system is very typical of this time of the year. If you look back at the last 15 or 20 years, every year you will find that in February and March, liquidity tends to become very tight. And there are a number of reasons for that. So one of the fundamental reasons is that there is a large amount of tax payment which has to be made on 15th of March. So suddenly a huge amount of liquidity gets sucked out of the banking system. It goes into government coffers, and then the government really starts spending that money only post-April. So the liquidity will re-enter the system as we get into April and May, and that will ease interest rates. But currently, February, March always are periods of time when liquidity is tight.
KK, finally, the Indian economy has slowed down considerably post the recent political developments. What are the steps that government can still take to revive the economy?
See, growth has been slow for the last couple of years. Basically, what we've seen in the last 7 or 8 months in terms of action from the government has been very, very positive. The increase in the diesel prices, the increase in petrol prices, the increase in rail prices, all of that have been far from populist measures. Even if you see the budget, the finance minister has delivered, as promised, a 4.8% fiscal deficit for next year and a 5.2% fiscal deficit for the current year. So a lot of effort has been made by the government in these last 7-8 months to try and bring the economy back on order. So I'm reasonably confident that that kind of trend will continue going forward, and hopefully over the next 3-6 months we will see if not the investment cycle actually restarting in terms of large investments being made, but at least sentiments at the ground level have been a lot better in recent times compared to what they were a year ago. So people are looking at investing, they're evaluating options, and at some point of time over the next quarter or two, you will see the investments flow through in the system.
KK, good chatting with you. Appreciate you taking the time out and joining us.